How does monetary policy affect investments? Have you ever wondered how decisions made by central banks can impact your investments? It all comes down to monetary policy, which plays a significant role in shaping the economic landscape. Monetary policy primarily influences investments through its control over the money supply and interest rates. When a central bank increases the money supply or lowers interest rates, borrowing becomes cheaper. This encourages both businesses and individuals to take out loans for investment projects, leading to a temporary boost in economic activity and asset prices. However, from a libertarian viewpoint, such interventions can distort the natural signals of the market. When interest rates are artificially low due to credit expansion, it creates a misleading impression that certain investments are profitable. Entrepreneurs may start projects that would not be valuable under normal market conditions. This can lead to a misallocation of resources, often referred to as a boom fueled by easy money. As time goes on, this boom can become unsustainable. If credit expansion continues without checks, it can lead to inflation and speculative bubbles. Eventually, these bubbles burst, resulting in economic downturns or recessions. If credit expansion halts abruptly, the economy may face a sharp correction or even a depression. This cycle of boom and bust can harm long-term investment stability and economic growth. Libertarian thought emphasizes that discretionary monetary policy, where a government or central bank actively manipulates money supply and interest rates, creates economic instability and uncertainty. This undermines capital formation because investors struggle to predict the true cost of capital or the real profitability of investments. Instead, libertarians advocate for sound money policies. These include returning to a gold or silver standard or allowing free market competition among currencies, including decentralized digital currencies like Bitcoin. Such approaches aim to limit inflation and government interference, preserving the purchasing power of money. This creates a stable environment for investment decisions based on real economic conditions rather than artificial monetary stimuli. In practical terms, monetary policy affects investments in several ways. It influences borrowing costs through interest rate changes, which directly impact business expansion and capital projects. It also affects inflation expectations, which can influence long-term interest rates and investment returns. Furthermore, it creates cycles of boom and bust by distorting market signals when credit is expanded artificially. Lastly, when monetary policy leads to inflation or economic instability, it undermines investor confidence and capital formation. From the libertarian perspective, minimizing government control over money and allowing market forces to determine interest rates and money supply would lead to more sustainable investment patterns and economic growth. This viewpoint warns that monetary policy interventions often serve to finance government spending and expand state power, ultimately at the expense of individual economic freedom and stable investment environments.